This contract went from $885 to $6,355. So this video is going to be about how I make money on the stock market using swing trades, very, very rarely day trades, and uh, option trades. Hello, everybody. My name is Phillips Persons, and I want to start off by first saying options trading is extremely risky. You're going to lose all your money. I'm not a financial advisor, and everything I'm saying here is strictly for educational purposes only. Also, I want to mention that if you get into trading, putting your money into stocks or whatever, and you do not have good energy, you do not have good intent, the world is not going to bless you with more money. I'm sorry, that's just the case. You got to have good energy, good vibes, and that's how you do it. All the richest people you look around, they are powerfully present. Elon Musk, Jeff Bezos, Steve Jobs, they're all very powerfully present, and that's how they succeed in life. So if you're going to, if again, know where you are in your life, if you need to make the necessary changes in yourself first, do so before you put your money anywhere, because I promise you will lose it. I've been there, I've done that, so I can tell you from my personal experience. And without further ado, let me get into the video. Hello, everybody. I hope this works. I've never done this before. I am on Zoom. And first things first, before you start trading, get a long-term account. Do not trade any, do not go into gambling with this is essentially gambling on the stock market. Do not gamble your money before you have a long-term, and have most of your assets as long-term. So if you're not comfortable losing everything you have right now, then you shouldn't be trading options. You make sure you have a long-term. If you make a long-term, it will set you for life. Okay, but now I'm going to get into the more degenerate part of what you can do on the stock market. This is what options trading can do to you. I started with $6,900, was down here, down 70 something percent, down $5,000. And this point in my life, I had learned how to do options relatively well. Got lucky with a play, got lucky with one options contract. I hit a Beyond Meats play, and it rocketed me up to here. This, if we look at the weekly chart, first day it went up, I got about $1,000, a little bit more. The next day in the morning, I woke up to Beyond being a 52 all-time high, 52-week all-time high. So that was this run up here. Let's give you guys some background. In this time that it was going down, I was in a dark place in my life. My energy was not very good at all. I didn't have a positive outlook on my life. I wasn't doing anything near the things I'm doing today with as far as energy, the way I look at life, the way I really control my own destiny. With along with that, that reflects it reflects in your money. So if you don't want to see that negative 73%, that negative 5,000, that was heavy. That was a heavy burden. If you don't want to see that, um, know where you are in your life, because I'm telling you, energy is real. It's real. And it it will change your life. And for the better or worse, you have to learn your lesson. Let's start with December 11th, 2020. I know it's not going to make much sense if you don't understand options contracts yet, but just listen for now. Beyond 155 call expiring February 19th, 2021 at a maximum of $8.85 per share. Number one thing about options contracts, first thing to understand, they are like coupons. And each one of these coupons uh, has control over 100 shares of any particular company. So in this situation, I bought a Beyond Meat 155 call at $8.85 per share. That's so with times 100, that's $885. The contract was filled. I got it, as you can see right here, $885 per contract. So I got one contract. Here it says per share. Here it says per contract. Here on January 22nd, just to see how much it was sold for, I closed I closed this beyond contract at $63.55 per share for the contract says so an average of $6,355 per contract. So this contract went from $885 to $6,355. So November 11th, around this point right here, they were $138 dollars per share. But this is the point at which I bought the contract. And as you can see, the price actually went down. So at this point, actually, at this very date, the options contract was worth about $100. So I was in the hole $700. We had this big spike. So this is where the first thousand came in. Now, just note the prices. Just note the prices. Here it's at 156, around 160. Okay. And at this point, also note that I was up about $1,000. Then it shooted up to 200 and I actually sold it in the morning around this point. So I cashed out for $6,300. This is what a options chain looks like on Robinhood. But this is what an options chain looks like on E-Trade. And as you can see, there's a bunch of numbers, a bunch of stuff going on here. So it's kind of confusing to look at. But let me explain what an options contract is right now. Options contracts hold the right to buy or sell a stock at a certain price. And each contract has control over 100 shares. When we're looking here, there's two different types of contracts. There's calls and then there's puts. When you buy a call option, you're essentially buying the right to buy a stock at a certain price. So, what does that mean? Let's say we're looking at Beyond Meat. We're looking at Beyond Meat. Uh, you're me 3 months ago. The strike price currently is $138. So that's around the time when I bought my contract. So the strike price is about $138. I said in my mind, okay, I think Beyond Meat is going to be at least at 155 by February 19th. So, whoever I sold the contract to, they bought the 155 call. So now they have the option to exercise the contract, which means they can buy 100 shares at the price of 155 even if Beyond is up here at 188 or 200. So the price of the stock is at 200. You buy an options contract that for 155, a 155 call, you have the ability to exercise this contract and buy 100 shares at the price of 155, and then afterwards it's your choice to do what you want. You can sell it like immediately, so you can buy a 155 call, uh, exercise it, get 100 shares at the price of 155. So you spend $155,000, and then you can sell those 100 shares for the current price, which would be 200. So you would sell it for 200,000. So basically, you make the profit of whatever that is, and that's in a nutshell what you can do, what the functionality behind options contracts is. That's not what most people do with them, though. Most people just buy and trade options contracts, and most of these contracts expire worthless. Expiring worthless. What does that mean? So, when we look at these options contracts, here there's an expiration date. And uh, as you can see, you can choose contracts all the way to 2023. So far, far away. And you can buy as close as ending this week. It's Wednesday, January 27th, and you can buy contracts expiring in 2 days. Looking at data. Data is important. Data is what represents time decay on these contracts. So, as we discussed, the contracts do expire. And when they expire, they're completely worthless. If they're not in the stock, if they're not at the strike price or higher uh, for calls, they will be worthless. So if I bought the 138 call and come February 19th, if Beyond Meat wasn't at the price 155, that contract would be worth nothing. So that contract I spent $885 on February 19th, if the Beyond Meat wasn't at this price, it would have been worth nothing. All the money's gone, and I would have had a choice up until that point to maybe sell out and get some profit back, not profit, some money back. Options contracts have various different things that determine their value. Is first of all, at what point did you buy it? So if you bought it at a point that everybody was looking at the stock and having a lot of hype, hype has value. If you're looking at a stock and everybody can just tell it's going to go up, and you bought an options contract with a strike price, where do you think it's going to go? It'll go up to that point, but if there's already a lot of if it's already obvious, you're not going to make much money. So, hype has value. If a stock is overhyped, that hype is put into the options contracts. So, hype has value. Number one, time has value. So, how much time is on a contract makes it valuable. So, if we look over here, January 23rd, as you can see, these contracts go for $7,000. There's a lot of time in these. So 3 years from now, these contracts are not going to really be affected by time decay at all. If we look, this is a very insignificant amount. The time is not going to be affecting these contracts at all. Okay, so now we know that hype has value, time has value. What else has value? What's the strike price you also buy it at? So where are you at the point at which you buy it, and where is the value of the stock? So January 29th, this stock has moved up a lot. So all these contracts are pretty expensive. If we looked at some other stocks that hadn't moved as much so recently, looking all the way this far out the money is very unlikely that they're going to have value. So look at January 29th. Look, you scroll up a little bit even, and these contracts start to have no value because it's just very unlikely it's going to get to this point. Big moving stocks that can move a lot, the contracts are going to have more value. Uh, Stocks like Coca-Cola don't really move much. Uh, Far out the money contracts are not going to have much value. Now, this could also be a good thing because when there is a surprise, these are the contracts that really shoot up a lot. So you have the opportunity to buy many of them. So if you buy many contracts for a very low price, it shoots up. You're a big winner. It's key that you find a move that people do not expect. That if you're taking a risk, the more of a risk you take, the more reward you have available to get. It's all about it's a risk. This is gambling. This is essentially gambling, a legal form of gambling. Move. What makes this move so big? So, the options contract that I had, the $885 contract that I spent, that actually was at a dollar or 100, around $100 lowest price, went up to $6,300. And for me, my percentage gain was over 700%, about 718%. But if we look at the stock beyond, uh, the the stock actually only went up only. It went up about when I sold it, it was up about 50%, about 50%. So, uh, if you would have put $885 you in just shares, you'd have only gotten $400. So as you can see, this options contract had originally that was worth $885 went up 700 over 700%. So it went up to 6,300. That's a lot significantly more. That's significantly more than what you could have made with shares. And that's partially not partially. That's because you're taking more of a risk with contracts, but they have a greater payout if you catch the move. At this point, I mentioned that I was up already over $1,000. How it works. I had the 155 call expiring February 17th. Since these contracts, uh, since these contracts control uh, the price of 100 shares, each dollar move above the strike price. So if I bought the 155 call, Beyond Meat goes to 155, goes to 156, goes to 157. Each dollar it goes up, I get $100 because it controls 100 shares. So that only happens after it goes past the strike price. So you only get $100 when it gets past the strike price. Whatever, however, depending what company you're working with, uh, contracts will vary in prices. Then I'm sure these ones down here get down to $34,000. These are some in these contracts, like whenever there's big moves, big hype, big stuff going on with a particular stock, this is what happens. Again, as we spoke before, hype has value. It's called premium. Premium is an important term. It's a term. It's a technical term. It's basically exactly that. I would like to think of it as hype. The way it works is you can bet on a stock going up and you can bet on a stock going down. If you want to bet on a stock going up, you buy call options. If you want to bet on a stock going down, you buy put options. Puts give you the right to sell a stock at a certain price. So if Beyond Meat is at 200, I buy a put option for 180. It goes from 200 to 180. And somebody buys my contract and chooses to execute it. They now have the ability to sell 100 shares for 200 when the price of the stock is around 180. So they now have the opportunity to sell this contract, to sell their shares at that price. Just as easily as you can make a lot of money, you can lose a lot of money. And there are ways you can lose infinite amount of money, because that includes selling contracts and selling 100 shares that you don't own. And technically, if you sell a call, if you sell a call over here, and technically the stock has infinite potential to keep going to the moon, and you sell this and you lose a lot of money. That's actually exactly what happened to the banks. That's why GameStop. This is why banks have been losing a lot of money. This is why Wall Street has been losing a lot of money, because they've been doing this exact thing where they sell options contracts. They sell these contracts, these calls. They sell them. They short them. That means they're selling these contracts, and you see how much money these contracts are worth. So these people have sold some big contracts, and GameStop is going far up to the moon, and they're having to front this money. They're having to give uh, to this times 100 times however many contracts they did that with at whatever price. They're losing a lot of money. This is why banks and uh, big corporate investors and all these big names are losing a lot of money right now, is because they're shorting this. They're saying that this stock is going to stay or it's going to go down. This is overhyped, which is a very realistic thing. to expect. But with all these um, Wall Street bets, people, Reddit page people, they're running up, they're pumping this stock. This is why this is happening. That's how they're losing money. So there's a lot more detail I can go into. I'll probably have to make a part two, getting more in detail if you want to learn more to how to work with debit and credit spreads, how to cut your losses, how to uh, kind of make more safe plays, because there are ways you can actually uh, make it so that you have um, you have a high probability of winning. You can make it that you have high probability of winning every play, but you also increase how much money, uh, like you kind of cap how much money you're going to lose, maximum potential loss, you cap that, and you increase your probability of winning. You can do that, but there's other things that are going to other cons. So there's pros and there's cons for each thing. I can get into more detail in another video, but for now, thank you for watching this very, very basic video. Be safe. Don't get into it yet. Just maybe pay attention a little longer, do some more research. I'll make another video doing a better job explaining more in detail these parts, but now just try and digest the things that I've explained here. Be safe, have good energy. If you're going to trade, have good energy. I'm telling you, it's very real. I've lost a lot of money with bad energy and bad decisions. Don't get too caught up. Thank you for watching.